how to account for income tax expense and income tax payable. And the second we are going to look at is how to make a detailed account for temporary taxation differences arising from accounting records and taxation records. So let's look at the first one, which is how to account for income tax expense and income tax payable. When we look at accounting transactions are event-based, and we record them on accrual basis, whether we receive cash or not. If the event occurs, we record that transaction. So the transactions that we record are cash and also non-cash. But when it comes to taxation, underlying assumption that we are making for convenience is that the transactions that we consider by the taxation office are cash-based. So any cash transactions during the reporting period are considered for calculating the taxable income. So the taxable income is the equivalent of the accounting profit. The profit is calculated using revenue minus expenses. For taxation purposes, the revenue is called assessable income, and the expenses are called deductible costs. And then from taking the difference, the taxable income is calculated. A difference between the two paradigms is that in accounting, the accounting uses accounting principles, but tax uses the Australian income tax legislation for such calculation. To go forward, we are making two assumptions. The tax will be paid in the next reporting period, and the income tax rate is 30%, and the tax calculations are based on the cash transactions, for the cash received or paid during the reporting period. So using accounting principles, we determine the accounting profit. So from the accounting profit, when we apply the taxation rate, we come up with the income tax expense that shows how much should be paid as tax. So we debit that expense in the income statement. From the taxation side, the tax office decides how much must be paid, and it comes up with the taxable income, and applying the tax rate, it then calculates the income tax payable. And so that income tax payable is what must be paid to the tax office, and we record that as a liability, income tax payable. So theoretically, income tax expense that we record as a debit should equal the income tax payable we record as a credit, but the liability is calculated based on the rules used by the tax office, and the expense is calculated based on the rules used by the accounting standards. So if you take illustration here, accounting profit and taxable profit, we can see that if they are equivalent, then we will come up with the income tax expense and income tax payable, what should be paid and what must be paid as equal. So we debit income tax expense and we credit income tax payable. So this is theoretically what would happen, but as I pointed out, the accounting uses accounting principles, and the tax office uses the taxation legislation. Because of these different guidelines that the two paradigms use, often income tax expense does not equal income tax payable. So if we take an illustration here, this is an activity for you to do it, so you can stop. You can pause the video here, and then you can do this exercise and then continue. Here you've given some items or some events that have occurred and given sales, cost of goods sold, amount received in advance for services provided, and rent expenses, rents prepaid, doubtful debts expenses, amounts provided for the year for long service leave entitlement. So based on this information that's provided for us, we can determine how much accounting profit is and how much taxable income is. Some pointers, I put some question marks there for you to think about because for accounting purposes, we will not include amount received in advance for services to be provided. Think about why we don't include that there, and then also think about for taxation purposes why we don't include doubtful debt expense and also amounts provided during the year for long service leave entitlement to come up with accounting profit and taxable income. Just another clue is that the taxation calculation is based on the cash receipts and cash paid. So what we do is we debit income tax expense, we credit income tax liability, debit and credit. As I mentioned to you, that they do not equal. But this unequal amounts between the income tax expense and income tax liability arises mainly due to the differences in rules. But it is the same asset or the same liability that we both consider, both paradigms consider. So uh, overall, that there is no difference, but the difference that occurs between the two are temporary differences, and the differences occur over time, these temporary differences, but these differences are typically net off because we are looking at for example, we are looking at the same asset, but accounting uses some set of rules and tax office uses a different set of rules. They're looking at the same asset and the same value of the asset. So any differences that arise is because of the time, and these differences are called temporary differences. So unequal amounts here between income tax expense and income tax liability are called temporary differences or temporary tax differences. Here's an example of those temporary tax differences. Asset cost $100 and there's no residual value, and the company determines that the asset has 2 years useful life, no residual value, and the tax office determines has 4 years of useful life with no residual value. We can see that accounting depreciation is in the first and second year, where the tax depreciation expense is over 4 years. Now we are looking at the same asset, and the asset is depreciated, that $100 is depreciated, and the total depreciation is equal to $100 in both instances, but amount in a given year is different because of the differences in the rules in the two paradigms. So what we have is there's more accounting expense and there's less tax expense. So when there's more expense, there's less accounting profit. When there's less accounting profit, there's less income tax expense or should be paid. And when it comes to tax side, there's less tax deduction, depreciation deduction. So there's more taxable profit, more tax to be payable. So must pay is more than should pay, and there's a difference between the two, and that difference is called the temporary difference. And when the difference is, when we look at the difference as tax, from a tax perspective, that is after applying the tax rate, we can determine that difference as whether it's an asset or whether it's going to be a tax saving or whether it's going to create a liability obligation for us to pay more taxes. But in this instance, for example, we should pay less, but we are paying more. When we pay more because the tax office asks us to pay more, by doing that, we will save more money for future taxes because we don't have to pay more in the future because we are paying now more and we will pay less in the future. So because of that, that difference in this instance is called a deferred tax asset because of that saving. So here's another example. In this example, we've taken the asset, the transactions, revenue and expenses, and the accounting profit and the income tax expense. So this is for the first year of that depreciation, and for the tax office, there's assessable income, deductible costs, and taxable income, and then income tax payable. So we can see that income tax payable is what must be paid. So we will record that first as credit income tax payable because it must be paid, and we debit income tax expense. So that's 22.5 and 22.5. But we know what we should pay is less. So because we know about the company much more than the tax office because the tax office is outside us. But company people are working there insiders, so they got inside knowledge. So we make an accounting adjustment to reflect the underlying reality of economic reality of the company. To do that, what we do is we make an adjustment, we bring down that 22.5 income tax expense to 15. So to do that, we credit income tax expense 7.5 and debit deferred tax asset 7.5. So what we are saying here from the accounting records is that we recorded what must be paid, but what should be paid is much less. And because we are paying more, what we are doing is we're going to record that that amount income tax expense as 50. So we credit 7.5 for that, and that additional payment 7.5 becomes an asset in the future. So we debit deferred tax asset. So our journal entries, first one is for the must pay debit income tax expense and credit income tax payable 22.5, and then the second journal entry is the adjustment to bring down the income tax expense, therefore, and to create the temporary tax difference. So we debit deferred tax asset and credit income tax expense 7.5. If you look at the depreciation expense and the tax deduction, we find that there's more accounting profit. There's less accounting depreciation expense, which is zero. Uh, that is towards the end of the third and fourth year. And there's more accounting profit, so there's more income tax expense. But when it comes to taxation, there's depreciation expense, uh, deduction, and there's less taxable profit, so there's less income tax payable. So the tax payable now less than income tax expense. So what must be paid is less than what should be paid. So the short for tax payable now becomes a reversal of the deferred tax asset. So we first created a deferred tax asset in the first 2 years, and the remaining 2 years we are now reversing that deferred tax asset. So by reversing the deferred tax asset that we generated now diminishes and becomes zero over the next 2 years. So that deferred tax asset therefore is a temporary tax difference. It's not a permanent tax difference. It arises and then over time it will vanish and become zero. At the end of the fourth year on the transaction, we look at the depreciation. We can see here that accounting does not have any depreciation expense. It's zero because the asset was depreciated over 2 years. The tax office will depreciate over 4 years, so there's deductible cost of 25. And then we record the income tax payable, which is 22.5. So our first journal entry is debit income tax expense 22.5 and credit income tax payable 22.5. And that's our first entry. What must be paid, we record. And then we realize, well, income tax expense should be 30. So we increase the income tax expense, debit income tax expense 7.5, and we decrease the deferred tax asset 7.5. So you can see in the first year we created a deferred tax asset. So we debited deferred tax asset first and the second year. And third and the fourth year we are now using up that deferred tax asset, or we are reversing that deferred tax asset, and that deferred tax asset become income tax expense. So that those differences, those taxation differences are called temporary taxation differences. So shown here the same journal entries, first for what must be paid, and second journal entry for the adjustment of the tax what should be paid. For that we have to make an adjustment entry. That adjustment entry is shown there. So we can see here, if you look at 4 years, and then there's income tax expense that we can calculate based on the profit that we come up with, and then in the first part, in the first top part, we are shown the accounting side of it, and the second part we show the tax side of it. In that we show the assessable income, tax deductible depreciation, taxable income, and the income tax payable, and we calculate the income tax payable, and we can see that income tax expense is not equal to income tax payable. So what should be paid is not equal to what must be paid. So there's difference in the tax, and that difference is called the temporary difference. And because what we should pay is less, what we must pay is more, when we pay more, that additional amount we pay becomes a tax asset. So debit deferred tax asset in the first year. And then in the second year we do the same thing. We debit deferred tax asset. And in third year, what should be paid is more than what must be paid. So we credit the deferred tax asset, we decrease deferred tax asset to increase income tax expense. And the fourth year, we again decrease the deferred tax asset to increase income tax expense. So ultimately, you can see here that the deferred tax asset that's shown in the last row, the debits, when you add up the two debits and then add up the two credits, the total debits and the total credits equal 0. So the deferred tax asset is a temporary asset or temporary tax asset that arises and then that vanish away over a time period. So I shown here as bar charts that it arises and builds up the deferred tax asset. And then in the third and the fourth year, it's been reversed, and ultimately the deferred tax asset becomes zero. The net effect of that, the deferred tax asset account will ultimately in the fourth year, end of fourth year, will be zero. So what we know so far is that income tax expense and income tax payable often are not identical, because what must be paid and what should be paid are different. And our first entry is for the what must be paid, and we credit income tax payable and debit income tax expense. After doing that, we make an adjustment for what should be paid to correct, to come up with what should be paid. So in this instance, in the example we looked at, is in the fourth year. What we did was we credit income tax expense and debit the deferred tax asset. Here's another example where what must be paid or the income tax payable is 80. So we credit income tax payable 80 and debit income tax expense 80. What must be paid, and what must be paid is less than what should be paid. So therefore, we make the second adjustment, that is, we debit income tax expense, which is 20, to increase the value of income tax expense in that account from 80 to 100. So we debit income tax expense 20, and then we have a credit, and that credit is called deferred tax liability. And that is 20. So now let's look at the second aspect, how to make a detailed for taxation purposes and accounting purposes. That difference, because when we make the asset value different, we are we are now using that amount as an expense. Here in this instance it is 10, and for tax purposes we are using that deduction, or that bringing down the asset value as a deduction, which is a tax deduction. So what we can understand is that these differences in the values are actually arising on the balance sheet, on the assets and liabilities. But those changes that are taking place on the asset are then reflected on the income statement, because when planned cost from 100 becomes, the carrying value becomes 90, the difference 10 becomes reflected in the accounting income statement as an expense. But they originate from the balance sheet, because it is that carrying value of the plant that has changed, and the carrying value of the plant is reported on the balance sheet. So the temporary tax differences can arise from assets and also from liabilities. We focus on assets and liabilities because the assets and liabilities are about the future cash inflows and future cash outflows. Because it is about cash and the tax is about cash, our focus is on the balance sheet assets and liabilities rather than the accounting revenues or accounting expenses. So it's another activity that you can conduct. You can pause the video and you can work it out. So it requires you to calculate the carrying amount of the asset and the tax base at the end of the second year. So please pause the video and then work it out, and before proceeding to the next slide. But I will proceed to the next slide. So I've given you some hints here. I've shown you the carrying amount for the asset and the tax base for the asset. And what I would like you to find out is the accumulated depreciation for accounting and for taxation purposes, and why that accumulated depreciation has been different between the two. Here I'm showing you how these temporary differences can arise for various assets and liabilities that are on the balance sheet, and how the differences in rules, the two paradigms, accounting and tax, can create these differences. For example, for non-depreciable assets, we look at the carrying value, and the tax office will look at the tax base using the cost less accumulated depreciation for tax purposes, whereas for accounting they will use the cost less accumulated depreciation based on accounting principles. When it comes to accounts receivable, the tax base will use the gross amount, will disregard the provision for doubtful debts. The provision is not cash, whereas accounting for accounts receivable is the gross amount less provision for doubtful debts. Inventory, there's no difference. And any other prepaid expenses, asset has carrying value for accounting, but for tax, the prepaid expenses has zero value because it is already prepaid, and it's that prepayment of expenses has been already deducted as a cash deduction in the previous period, but it's sitting there in the next period in the accounting records has a value for the accounting but has no value for the taxpayers because it's already deducted. When it comes to accounts payable and loans payable, we consider the gross amounts. When it comes to provisions, we show in accounting the carrying value. When it comes to unearned revenue or revenue received in advance, we show the carrying value. But for tax purposes, they have zero value because they are not cash amounts. Revenue received in advance, although revenue received in advance is cash, that cash has been already assessed in the previous period, but is sitting there on the balance sheet. But in this reporting period, the tax base for that asset, for that liability is zero. So when it comes to taxation differences, the difference could lead to a deductible temporary difference. That means that difference can help us when we calculate the tax amount in that. And if it is deductible temporary difference, then that will generate a deferred tax asset. And if it is taxable temporary difference, that difference when we calculate using the tax rate, that means we have to pay tax, there's obligation to pay tax. So that will generate a deferred tax liability. So here's a matrix if you want to determine the taxable difference and whether it's a deferred tax asset or deferred tax liability. So this matrix shows you asset and when the carrying amount less than tax base, so then it will give rise to a deductible difference, and the tax amount of that is a deferred tax asset. But if the carrying amount of the asset is greater than the tax base, that difference is a taxable difference, and applying the tax rate is deferred tax liability, and that liability is is a deferred tax liability. When it comes to liabilities, when the carrying amount is greater than the tax base, it's a deductible difference and gives rise to a deferred tax asset. Whereas the carrying amount is less than the tax base, the difference becomes a taxable difference, gives rise to a deferred tax liability. So this is another activity that you can conduct. In this activity, you find that this entity is going to generate profit, and there are 5 years in the next 5 years, and requires you to look at the taxable income, tax payable, income tax expense, and temporary taxable or deductible difference, deferred tax asset or deferred tax liability, to find out whether it's deferred tax asset or deferred tax liability, and then write journal entries that record temporary that temporary tax differences for each year. So I've shown here using the references, that is the required calculations that are required and work it out for you, the taxable income and the tax payable, and then what is income tax expense, and the temporary taxable difference, and the deferred tax liability, and then what is the journal entry, income tax expense, and deferred tax liability. So in the first 4 years, we generate a deferred tax liability, 3,000 credit, 3,000 credit, 3,000 credit, and 3,000 credit. So altogether, 12,000 of credit. And in the final year, that deferred tax liability gets reversed. So we debit 12,000 and we credit income tax expense 12,000. So we can look at the temporary difference to find out whether it's a taxable difference or deductible difference, using an analogy that if the tax base is lower and but the carrying value is greater, that means the company knows that they have to pay more taxes in the future. So that difference between the two becomes a taxable difference, and the 30% of that becomes a deferred tax liability. When it comes to liabilities, if the company has lower liabilities but tax office assesses as high liabilities, then uh, then that shows that company is richer, that it has less liabilities. If it is richer, then the value of the asset is lower than the tax base, then the company is poorer. And when the carrying value of the liability is greater than the tax base, company is poorer. So that difference becomes a deductible difference between the carrying value and the tax base. And that deductible difference, when applied, the tax rate becomes a deferred tax asset. So this difference in each instance is 300, and then 300 in 30% becomes 150. So we debit deferred tax asset 150 and credit income tax expense 150. There are some few items that can create permanent differences, and such items are like entertainment and goodwill impairment. They are not a tax deduction in any period. Such expenses can create permanent differences, and those differences are used when we determine the income tax expense, what should be paid. So they are already considered. So we don't have to worry about when we try to determine the temporary tax differences, because they are already considered when determining the income tax expense. So here's another activity that you can conduct. This machinery, interest receivable, and accounts receivable. What you need to find out is what is the carrying value and what is the tax base, and what is the difference between the two, and that difference, is that difference a deductible difference, tax difference, or taxable difference, and then applying the tax rate. If it is a deductible difference, it become deferred tax asset. Applying the tax rate for the taxable difference become a deferred tax liability. So I'm going to play a video, and what I would like you to determine is, after watching the video, how does deferred tax asset arise? How does deferred tax liability arise? Are deferred taxes permanent or temporary differences, and why? Is prepaid insurance a deferred tax asset or a deferred tax liability, and why? So keep in mind these questions and then watch this video, play this video, and then get back to these questions and then try to collect your thoughts.
Hello everyone, we're looking at a no-joke item today, deferred tax assets and liabilities. So let's pretend for a second that Little Bo Peep Incorporated is suing your company for losing her sheep. And it's quite a lawsuit for $1,000, well not $1,000, how about $1 million? How about $1 million due to punitive damages? You called up your attorney who said, hey, sure enough, it's very probable she will win. You know your GAAP rules. You have to accrue your loss due to lawsuit right away as soon as you know it's probable. And you will show a contingent liability on your balance sheet. So loss will obviously create a lower net income right now on your books. However, if you take a looks return, the IRS does not allow you to deduct the loss until you actually pay it in cash. So there's no difference right now on your tax return. Let's take a look in the future. In the future, when cash is paid, you will have higher deductions on the tax return because you will subtract that loss. And it will create a deductible income on your tax return. Deductible income is a good thing. Think lower taxes, and it will create deferred tax asset. Similar expenses or losses will be warranty expenses. That is very much popular. Let's take a look at one more. I'll give you this example. Let's pretend you are using normal accrual accounting for your books, but you are strictly cash basis on your tax. Okay. And you prepaid for your insurance. 1 year contract, well, 2 years, 3 years, whatever it could be, the longer the better, because we're talking about the future. On your books, you will debit prepaid insurance and credit cash. There's actually no effect on your net income right now. Why? Both are assets. When you look on the cash basis, you will have to expense full amount. Why? It's cash, and you spend cash, so it must be your expense. So it will drive your taxable income low currently. However, in the future years, your deductible expenses for this item will be zero. You already spend them up. If your deductible expenses or your deductions are zero, that will drive your taxable income high, creating higher taxes in the future, or it will be deferred tax liability. Okay, key items as you look at various items that might be on your CPA exam. Maybe create a chart like that. Know your accrual basis of accounting very well. See what's going on your books. Take a look what's right now in the tax return. So obviously you will have to have good understanding of your basic IRS rules. And then really triple think about your tax return in the future. And be careful with those deductions because they will have an adverse relationship with your tax.
Or temporary differences, and why? Is prepaid insurance a deferred tax asset or deferred tax liability, and why?